$150,000 per year your money is making. That's $684 a day just from your portfolio. So at what point does an extra hour of work start to have diminishing returns compared to what your capital is already doing for you? That's what you should constantly be asking yourself. What I've noticed though is that people who are successful in their careers, well, they sometimes are workaholics. Even though they've already made enough money to live a fulfilling life, they already have enough money to perhaps retire early, they still continue working way too much. In fact, one of the top regrets of people on their deathbeds is that they worked too much throughout life and didn't get to enjoy it. So I would say work hard when you're young and you're establishing yourself, but if you're constantly growing your net worth and your portfolio is growing and your income is growing too, maybe just audit how much you're working. The last thing I would want to see you do is work 80 hours per week and all of a sudden you're the age of 65. Trap number 6 today is overconfidence from early success. Now, if you are someone who finds themselves quite successful, especially early on in life, this trap is for you, which is that you could become so overconfident from your early success that it could actually sabotage you. I'm gonna give you an investing analogy here, but I had a friend who liked to diversify his portfolio into 10 stocks at all times, and that was his entire portfolio, just 10 stocks. That already falls into trap number 1 today, which was overconcentration, but it's also incredibly risky, but that's what he was going for. He wanted high risk, high reward. Now, this strategy admittedly worked quite well for him in 2023 and 2024 when he picked 10 stocks that did well those years. I mean, not all of them were winners, but let's say he picked 8 great ones and 2 bad ones. Overall, his portfolio did really well. So after this happened, he suddenly had this bravado about him that he suddenly believed that he was the greatest investor of all time. So what did he do? Unfortunately, this person doubled down and they started to take bigger and bigger risks. Those 10 stocks that he had in his portfolio, he decided to concentrate even further and just go down to 5 stocks. He would even buy call options on earnings dates and trade on margin from time to time. And I recently heard from this said friend, and he is down over 30% in his portfolio this year alone, when the S&P 500 is only down about 2% overall. So the hard truth here is that sometimes a 2 to 3 year hot streak doesn't make you a great investor. It just might mean you got lucky in a bull market. The longer your overconfidence goes unchecked, the more painful the corrections might be. Statistically, 90 to 95% of day traders lose money over a long period of time. So I would say if you're trying to get into day trading, just don't. Let's move on to trap number 7, and that is when your finances become too complex. When you start growing your net worth and earning a good income, you may start to diversify your investments into many different places. People will have multiple brokerage accounts, multiple bank accounts, angel investments, private investments, and they might even enter into real estate partnerships.